You are welcome to Financial Analysis in 10 minutes. And in this financial report, we are going to be looking at the financial ratio analysis of Google for the past 10 years. All these data were gotten from the financial statements of Google. You can get it on Yahoo Finance. And in this video, we want to look at the liquidity ratio and the profitability ratio. They are important KPIs. As a financial analyst, you need to know that business owners, lenders, creditors, suppliers, management, they don't joke with these ratios. Because one thing liquidity ratio measures is it measures the ability of a company to meet its short-term financial obligation. So you can see that it's possible for a company to be profitable yet not liquid. You see such a company filing for bankruptcy at the end. Why? Because they were not liquid. They were profitable, but they didn't know how to manage their liquid position well. So many companies want to know how they are faring when it comes to their liquidity position. And some companies also don't know this. And as a financial analyst, that is why it is imperative to know how to bring it out to them so that they will know their liquid position. They will know how well they have managed their working capital and their cash flow. Because one thing liquidity ratio does is to help a company to see its liquidity position, its working capital management, and how well it's able to meet up with its short-term financial obligation. While the profitability ratio talks about how well a company is when it comes to generating profits. Because the reason why a company is in business in the first place is to generate profits. And we measure majorly three categories of profit, which is the net profit, the gross profit, and the operating profit. They all have their goals. They all have their aims. Gross profit has its own, operating profit has its own, while the net profit, which is called the bottom line, also have its own. So we don't just focus on one because there is a need to measure them separately. The operating profit, for instance, focuses on the core operation of the business, while gross profit talks about measuring the cost of goods sold to the revenue, looking at it after we have deducted our cost of goods sold from our revenue. Are we generating profit? What is the amount of profit we are generating? They want to look at their markup. Is our markup right? Majorly is to look at markup, to look at their margin, their markup, whichever one they are using, in order to generate gross profit. While net profit measures the overall profitability of the company. And you can see from the visual representation here, looking at it, the first visuals, it's a comparison between the current ratio and the quick ratio. The current ratio, the formula for it simply is you divide the total current asset by the current liability, total current liability. Total current asset, you divide the total current asset by the total current liability. Both of these parameters, both of these metrics can be found on the statement of financial position of Google. And just like I said, you will find it on Yahoo Finance. That's current ratio. So what we can see here is the average. Is the average. If we want to look at year in, year out, year on year, we will have to click on the slicer here. And you can see, as I'm clicking on it, year in, year out, it will be changing. It will be changing. Say 2016, for instance, you can see the current ratio is at 6.29. This, for instance, indicates two things. It may be more than two, but majorly it indicates two things. In 2016, for instance, that it is 6.29. The moment current ratio is above 3, it shows that a company is either not utilizing its assets to the fullest, or they are sitting on excess cash. Inefficient utilization of current assets, or they are sitting on excess cash. So in the case of Google here, it is likely that they are sitting on excess cash. Even by the time you look at it from 2014, 4.69 is on the high side. And you know, Google is a service company. It's not as if they are selling goods. They render services, especially, I think a major part of their revenue is Google AdSense. So you can see the current ratio as well. Even looking at the cash ratio, that the ideal range should be 1 to ratio 1. You can see that it is 3.87. This is excess cash. So you can see this is an indicator. That's why you don't just look at 1. That's why we don't just look at current ratio. You look at the quick ratio, you look at the cash ratio as well. So the management may come and sit down and look at it. For instance, by the time you get to 2023, you will see that this liquidity position has improved. You can see that it has now become moderate. Why? Because I believe that the management of Google, the shareholders paid attention to it, that we are sitting on excess cash. We are not making full utilization of our current assets. So you can see that from 6.29 in 2016, it is now 2.10. This is the ideal range. The ideal range for current ratio is 1.5 or 2.0 to ratio 1. That is the ideal range generally. Even though we have, it depends on the industry, but the ideal range generally is 1.5 or 2.0 to ratio 1. While the ideal range for cash ratio is 1 to ratio 1. So it means for every $1 that Google owes to its creditors or to its lenders, they have 1.36 to pay back. This gives creditors, this gives suppliers, this gives lenders confidence in the company that these people can make up, they can meet up with their short-term financial obligation. So lenders will love to do business with companies like this, whose liquidity position is in top shape. Even if it is 6.29, just like we saw in 2016, or 4 they are comfortable doing business with companies like this. But just like I said, to the management, it shows that they are not utilizing their assets, their current assets. They are not maximizing it. There's inefficient utilization of their current assets. So either way, it is not just the advantage we look at, we also look at the other way. What could it mean? So quickly, let's look at the visuals. So one major thing that needs to catch our attention there is, why is the current ratio and the quick ratio the same? The major reason for this is because the formula for quick ratio is same as current ratio, except that you will deduct inventory from the current assets. You know, for current ratio, it is current assets over current liability. So quick ratio simply is current assets deduct inventory over current liability. So they want to say that, okay, let's deduct your inventory and let's see how fast you will be able, how quick you'll be able to meet up with your short-term financial obligation. That is why another name for quick ratio is also acid test ratio. But when you look at it, they are the same, which means, does it mean Google does not have inventory? Yes, they won't have inventory, even though they have, but it's not much, very minute. It's almost imperceptible, their inventory, because they are not an inventory carrying company. They deal with services. That's why their current ratio and quick ratio is at par. They are the same, except for 2015 where we have 0.1, and that's insignificant. 0.1 difference. But all through the year, from 2014 to 2023, they are the same. So that's why we needed to compare current ratio to cash ratio, because the formula for cash ratio is simply cash over current liability, absolute cash over current liability. So even at that, they still maintain a good liquidity position. One thing liquidity also looks at is when you are looking at the going concern of a business. Once the liquidity position is threatened, then the going concern is also threatened. That's why shareholders also pay attention to this. How is their liquidity position? Hope it's not a company that will go and file for bankruptcy at the end of the day. Hope it is not a company that will not be able to meet up with its short-term obligation. at the end of the day. Because there are some companies that are solid when it comes to fixed assets, non-current assets. But when it comes to current assets, they find it hard to manage their working capital. That's all we want to analyze in this video. It's just the current liquidity ratio. Since it is financial analysis in 10 minutes, I don't want to exceed at 10 minutes. And if you are yet to subscribe to this channel, kindly do, as we'll be looking at many companies in the Fortune 500 companies. So if you are yet to subscribe, kindly do by clicking on the subscribe button and click on the notification bell so you can be notified whenever we release a new video. So we meet in our next video. Stay blessed.